Hi, Jeremy. It's a pleasure to have you as a guest in my talk. It's the first one in English with German subtitles, so I'm quite excited. Jeremy is a CIO, the Chief Investment Officer of WisdomTree. Their ETFs are quite popular in Germany and, of course, also on Wikifolio. And they have recently launched a new defense ETF, which was extremely successful. So I would love to have your flow in all my products every day. So
It, it
thanks.
was it was amazing, Andreas. It's great to be with you. Very interesting platform that you have there. And what a day to be talking about what's going on in the world markets. It's a monumental day, really, for the markets.
Yeah.
Very big news. And that was our most successful ETF, maybe ever. I've been working with WisdomTree 20 years, and it's not often that you can hit a theme right as it is the theme for the market. So, yeah, that's love to do it again. But this is a great one.
Even more thanks for getting up early. You are based in New York, around New York currently?
Yeah, I'm in the Philadelphia suburbs. I worked with a professor at the Wharton School, Jeremy Siegel. He has a book, Stocks for the Long Run, that I'm his co-author on, the sixth edition. We've been together 25 years since I was his undergrad student at Wharton, and I stayed in Philadelphia, so I'm still here.
Uh, Great. Maybe to start with easy questions before we come to the hot topics of today. Can you just summarize what is special about Wisdom Tree? And as a CIO, what are you doing all the day long?
Yeah, so today, Wisdom Tree, we have about 115 billion of assets around the world, about 80 billion out of our US business, about 35 billion out of Europe. In Europe, we have a big emphasis on commodities. We were one of the first commodity investors between gold, all the individual commodities, baskets of commodities, but also, we have a usage range from thematics, core equities, quality dividends. Our proposition in the US 20 years ago when we started was creating a better index. And, in equities, like, we saw everything at the first start 20 years ago was market cap weighted. We had a fundamental based approach focused on dividends, rebalancing to fundamentals. But, and people thought of us as a dividend player, but we have quality growth, thematics, as you mentioned, the defense strategy, and we're always trying to create a smarter approach. And as defense as an example, there's a lot of ETFs out there that would just have a lot of aerospace companies, and we sort of tilt towards who are the true defense companies. Where is your revenue exposure? So trying to be thoughtful. I mean, it's really creating a better indexing experience at our core, is and sort of unique value propositions across the range.
And so, in your role as CIO, how does your day look like?
Well, I oversee the investment function. We have about 30 people globally in research. So we're building indexes. So we were the first firm to say we're not just going to launch an ETF, we're going to also create the index. If you look at traditional big ETF players, they would go to MSCI or Russell or S&P and license their intellectual property. We started 20 years ago building our own indexes. Doesn't mean we won't partner on appropriate things. If we think there's unique IP out there, we certainly have been adopting it and using it for certain products. And in Europe, they have a lot more trading vehicles, so they'll use some of the popular benchmarks for some of those. But I think we're definitely creating strategies, is the core proposition, and that's across equities, fixed income, commodities, model portfolios, cryptocurrencies. It's really I oversee the entire investing function. So we have a lot of sub teams focusing on all the individual baskets and managing that, and then talking to clients about it.
So, more or less, you try to understand the world with a lot of chips on the table.
We have a lot of chips on the table. There's no
We,
question.
we should trust you. Especially, I trust you because I have really read this book, Stocks for the Long Run, back in 2008, where you have this written together with Jeremy Siegel. And I love it a lot. So, if I would have to recommend just two books, I would take The Child Investor from Benjamin Graham and
Yep.
yours as the most important reads. So,
Well, I
the,
appreciate
the
that.
last simple question I have is since 2007, where I had the book version, what has changed? Is everything still true? So I think the key message was nothing beats stocks in the long term. Is this still true?
Well, we had 200, Siegel compiled 200 years of data, and he has the longest time series on the major asset classes for the US markets, and it's stocks, bonds, bills, gold, the dollar, power of inflation. And after inflation, and inflation is a key topic of the day, with risk. What do you do? Could you go gold at all-time highs? And it's been surging the last few years. Um, when you look at the compounding of stocks, his number said 7% real after inflation, a little bit under 7% for the US market. Bonds at about 3.5% over that time period. Gold was under 1% real for 200 years. Now, if you go back last 50 years, gold was like the second best asset in real terms, but stocks were the best. And for high inflation periods, what you see, I mean, we're going to talk tariffs and all these situations. When companies' costs go up, companies tend to raise prices and their earnings tend to go with inflation over time. And, so that stocks have delivered the best. Now, we don't know that stocks or bonds can still do this historical returns. They did almost 7 for stocks, 3.5 for bonds. The US inflation bond today is around 2%, under 2% today. That's a good indication of forward-looking returns for bonds, 2% real. Stocks at a 20 PE on the S&P 500 is only like a 5% real, 5% earnings yield. But the equity premium, we would say, is still 3. The 5% versus 2 is a real return difference. And we do think stocks will beat bonds comfortably, but both are, lower returns than their long-term average. So there is no question. And it's interesting. In Europe, you could say the spread is even more, but we talked about this on my podcast last week. Europeans don't like stocks for some reason. I mean, this is one
Yeah.
of the big
That's
conundrums.
why I mentioned your book, because we have to educate the people here more on stocks and investing around. So some weeks ago, I heard a video from Jonathan Steinberg, WisdomTree's CEO, and I saw a lot of passion about Europe in your company. And then, according to Handelsblatt, Trump said, I think yesterday, about Europe, sometimes your friends are the worst enemies, when he announced this tariff topics. How do you feel about this when your president says Europe is an enemy?
Well, it's really this economic question, and he's definitely trying to do two things in the relationship with Europe. There's a multifaceted negotiation going on. We talked about defense and the theme for European defense stocks. There's been, there's some general feelings out there that the U.S. has been the policeman for the world, and of our 30 trillion in debt. My friend Jim Bianco put out a statistic. I don't know exactly where he got it from, but like he claimed 2/3 of the debt of the US is from all of our military and defense spending.
Mm.
And they're saying whether or not that 2/3 number is right, the big part of our debt is because we've been spending to police the world. And the idea is, well, we're not going to do that anymore. We have our own debt challenges. We can't defend everyone. And now you have this real battle on your hands over with Russia, and you have to take that very seriously. And the question is, what is going to be the U.S. role in all of this dynamic? And Trump is trying to say, Europe, you haven't paid enough for your defense. There's this whole NATO question. He wants people to get above 3% defense. Poland's spending 5%, but where is everybody else? And so this is one of the key conflicts of how much are we spending on defense and how much debt. And so that's reignited that discussion. And then the second is on, and there was a 20-minute interview from the White House yesterday with Steve Moran, their trade representative, that we have been basically encouraging people, US companies, to produce in China and around the world, and disincentivizing people to produce in the US, that we've outsourced all of our manufacturing. Really, the main, well, in this, you could see China is held out versus everybody else in many ways. I think the COVID dynamic had a lot of worries of critical materials, critical supply chains in China cut off. And during a pandemic, they're worried about China cutting you off. They have no production of critical things in the US, they're very worried about this. So this is not just well, where are we, where are we producing? They're really worried about some national security related things, and they're worried about the long-term relationship with China. So, which is how do you bring back manufacturing of certain things to the US? That is their goal and fear. And so we've incentivized it to go everywhere else. And so he's trying to redo all these supply chains. And now the question he says, I said he had a strong argument with reciprocal tariffs. You tariff us high, you can lower your tariffs by just reducing
I
it.
understand both your positions. The thing on the defense side, maybe this was the kick in the ass that the Europeans really deserve. And also understand the outsourcing to China problem. But if you look at the tariff calculation he has done, there was some critics in Europe that it was completely wrong, not even weighted according to real trading flow. Do you believe that this 39% of tariffs from Europe is correct, or is this just some ugly trick in the PR work?
Well, it's a fascinating dynamic. There's all sorts of debate. He had his table of what is not just the tariff policy, but the quote unquote currency manipulation, the trade restrictions, and how hard it is. And we're going to give you a 50% discount on that. And he, there was a lot of conversation that what basically they were showing is he's trying to get to, it was basically a calculus on what is our deficit, what is our import deficits on goods with these countries, and related to that versus the actual tariff policy. It was more like your trade balance versus the actual tariff. And so it'll be very interesting as he negotiates further. They said one thing that's predicted, there's this question of how much is uncertain, how much is he just negotiating with people, and that we will come to a deal. And I think what has shocked the market today is people thought he was negotiating because you saw the Canada and Mexico, we were going back and putting 25% on. Oh, well, they're going to do some things for restricting the border. We'll take the 25% off. And there's this sense that there's going to be this negotiation is not going to be as bad. And now people are like, oh, no, he's serious about some of this stuff. And that we're going to have a higher for longer tariff policy. So
but in the end, so there is a part is potentially show, a part is real negotiation. But we have in the end, will we have on average higher tariffs, and will this be the end of global trade, or not? Will it be just more symmetrical and fair from your perspective, or will it really decrease or kill global trade in the future?
I think he's trying to really bring back more manufacturing back to the US. There's no question that is, if you listen to this 20-minute interview they did at the White House with the key people, that this is a real intention to bring stuff back to the US. And so they do believe there's a lot of security vulnerabilities by having critical things produced around the world and not in the US. So there is some trying to bring it back to the US as a policy, or at least incentivizing US. They want it to be incentivized to be in the US versus incentivized in China. That's their key goal. Okay. So now
but this means we have two aspects. If it's about strengthen the local economy, this means less global trade. This means the potential to really have tariffs as a revenue for the government is then lower. If you look back in, I think, 1910, almost half of government revenues in the US was tariffs. So you assume it's more or less assuming changing behavior of the economy, of the consumers, to strengthen the US internally, and not to see tariffs as a source of additional revenues? Or is it maybe still both?
It's both. I mean, he has talked very much about, now the question is, how much can he get done? How much spending reduction can he do? He wants to make his tax cuts permanent, but he's also talked about going beyond that. He's had a very populist style to his rhetoric, and he said he wants to lower income taxes. He's put out a proposal that people making below 150,000 would have no income tax. And so that now, and he's got these deficit issues as it is, and the borrowing questions, and he wants lower interest rates. And so he's got a lot of things he's navigating, but he is trying to bring more revenue from tariffs. He wants to lower income taxes. And it's going to
I
be.
think this is a very interesting thing. I have never read in an Austrian newspaper that Trump's aim to have no tax for people less than 150K a year. Nobody writes about this in Austria. At least I did not see it. But do you think this can be achieved in a short time frame? Is this something for end of the year, or something in as a vision and will be delivered in 10 years, or never?
Well, it's very tricky to get to that math. I know the rhetoric why he wants to do that. I mean, it's definitely a very strong political argument, and we'll see. He's got to get things like that. He needs to really reduce the government spending. He said his Department of Government Efficiency is going to remove $1 trillion of spending. Elon has said they're up to reducing 400 billion. Let's see how much they can actually get. They had a $2 trillion deficit, and they're trying to, do half from spending reductions. They think tariffs are a new source of revenue. They want to extend their tax cuts, and they want to go further. So he's trying. It's tricky he's got a very slim coalition to get bills passed, and he hasn't been able to get anything extended yet. So he's got to raise his debt ceiling. He's got to extend all these tax cuts, and he's got this new uncertainty. A lot of this trade policy is not a traditional Republican policy. This was very much a union type policy versus a traditional Republican policy. So he's got a complex thing to navigate to get everybody on board on all of his policies.
So if you look at this from the investor's perspective, we have seen a major correction on Nasdaq and S&P 500 in the last month. What do you take out of it? Is this a reaction of less trust in Trump's policy? Is this uncertainty in the market? Or is it a correction that was really due because of high valuations? What do you take out? Is this a big thing to jump now on US stocks after the drop?
Well, it's fascinating, and I'll refer back to like what you said to me on Behind the Markets last week from people on your platform. I mean, you noticed that there was a huge amount of people who were allocated to the US. They reduced the US and started buying Germany. They started buying Rheinmetall. They started moving from US around the world. And I thought that was a very interesting anecdote of what's happening around the world. And mostly in Europe, let's say, that the Europeans were bringing back some of their money. Today, you see the euro moving up a considerable amount. Part of the goal of their policies was they think we have a very strong dollar, and that's hurting our competitiveness in some degree. But part of it is the US market has been the best place, and foreign investors coming in, will this new uncertainty get money to come out? You had Scott Bessent say this is not a MAGA problem, this is a Mag 7 problem, that you had these tech leaders. And I'd been saying for a while that Apple was vulnerable. It was producing in China. It had, its competition from Huawei phones. It was behind on some of the AI stuff. And you see Apple being hit this morning as a example of at risk of some of these tariff dynamics and being an expensive stock. Buffett reduced it dramatically because he bought it at 12 PE, got up to over 30 PE. And so there's more questions on the Mag 7 on an earnings growth perspective. You have the chip companies like NVIDIA, they're still exempt from some of the tariffs. Semiconductors are exempt, but there's this question on just overall valuations and the dynamics. I do think each one of those Mag 7 stocks are becoming more idiosyncratic. It's not all going to trade as a group. They each have pros and cons, different things. But their valuation has come down, and it's hard to say it's not justified to have a premium for those stocks versus everybody else. They are growing faster. The AI narrative is still, I think, early innings of what AI can do for us. And so but there is some valuation compression and this extra uncertainty. The more uncertainty there is, that does tend to compress the high multiple stocks.
So what I can tell you about the past 7 days behavior, in contrast to this big shift we have seen the last months towards Germany. In the last week, we have seen buying the dips on different US stocks, jumping the SIP signals on European stocks, and taking profit and fear of missing out, mostly on small caps all over the world. This was what we could see in the last 7 days.
Very interesting. Yeah, I mean,
So
and you see, U.S. small caps have been the real laggard for the last 4 or 5 years, and part of it is this unprofitability segment. They have, I mentioned, in rushes of uncertainty, right, and again today, small caps seem to be hit the most. They have more consumer stocks. They have a lot of biotech stocks which are unprofitable. I think AI is going to actually help the development of biotech,
yes.
but it you got regulation issues. There's questions with RFK going to the White House, what that's going to mean. Again, so policy related uncertainty. I think long term, I'm very bullish on the potential for biotech, but there's just a lot of uncertainty right now with the administration. But I think the drug discovery is going to go much higher with AI. So there's pros and cons on it at the moment, but the unprofitability nature makes it tough in an uncertain environment.
So one more question from my side, back to the tariff topics. This is extremely hot currently. How long will this dominate the press? Is this something that is over after summer, or is tariff war something that will last for the next 10 years and be as important to discuss about that compared to employment rates, interest? Is this something that stays, or is it over in the summer?
I think I think what you're seeing today is a real shift. I mean, what you know today, this is day one after the big announcement yesterday. The White House is saying you should have certainty that this is with us. This is the new policy. It's not going away. We will negotiate. And the reciprocal argument is if you lower, you got to now they're talking, it seems more than reciprocal because of what we talked about. They're looking at that trade balance versus just what is your tariff. So that trade balance question is a very thing hard to navigate if as long as that's the benchmark for them. And so I do think these things are longer lasting. And the question will then be, it's not so easy to stand up a new manufacturing plant. That stuff doesn't happen overnight. So it's going to take time for people to again shift the supply chains and where they focus. And I think there'll be more geopolitical. I mean, I mentioned China is one of the key challenges in all this. What is China's response? What is the EU's response? And how do we move forward? But so I think there's going to be volatility will stay with us. I think that is definitely an overarching premise here.
Fine. Very interesting views. It was a pleasure to talk to you. I hope that we can have more discussions in the future. As you
Absolutely.
framed it, this was day one. uh,
Yes.
let's see what the next 1,000 days will deliver. Thanks for
It
joining.
was great. Thanks, Andreas.